Regional banks continue to collapse. And I wanted to go live and explain to you guys how banks function, what the repercussions are going to be for you as taxpayers, bankers, customers, investors, and how it's going to be affected your bank accounts, your investments, your finances, your loans and processes, so forth and so on. And so I want to give you guys a little bit of insight on what's happening right now, what has actually hit mainstream media. Now, bank closures are not something that are rare. Community banks get hit like this regularly. In fact, the FDIC will shut down dozens and dozens of banks and institutions annually, but we don't hear about it because a lot of times the FDIC keeps it incognito. They don't want the customers to panic. And so a lot of times when you see banks switch names quickly where they're not advertised or you don't see them on the New York Stock Exchange that are publicly traded, it's because the FDIC came in and took over that bank and then sold it or auctioned that bank off. Now, what happens typically in banking is this. So a bank is a business just like any traditional business. If you're an investor and you're investing in real estate, you function or you should be functioning like a healthy bank. And so when you go out and you get money from people. So like if you are raising capital, that capital is a liability because you have to pay debt on that liability. So deposits from the banks to get capital from people, those deposits are a liability to the bank because the bank has to pay those people back interest. Plus deposits cost banks about 3%. Okay. By the time they pay the feds, pay the taxes, they pay the bankers, and they pay cost to their employees, the facilities, and actually an overhead to actually run that bank, it's about a 3% cost on every dollar that's deposited into that bank. So they have a 3% liability. So the bank has to go out and lend that money in excess of that 3% to be able to generate revenue. Now, how do they get this money so that it cash flows? They invest in assets, just like an investor, just like a multifamily syndicator, just like somebody that's going out and investing in storage or warehouses, somebody that's investing in the stock market, somebody that's investing in bonds, somebody that's going out and investing in startups. Whatever their business model is, they're investing in an asset that is income producing. And so a lot of these banks that are going down right now, they were investing in either startup businesses, or they were investing in Silicon Valley. And so like a lot of what happens like in Silicon Valley with the tech industry is a lot of these business require a lot of upfront capital to get their business going, but they don't have a lot of cash flow. So because they don't have a lot of cash flow, they're not having a lot of deposits to be able to give back to the banks. There's no revenue. Those assets don't produce revenue for them. So like a healthy investor, what you do, the way the banking system works and the way the investment system works is you take money from one source and you invest it into an asset. That asset produces cash flow for you. Okay. So when we're investing in like real estate for sake of example, I've always talked about how cap rates have to follow in line with interest rates, because if cap rates are if real estate is being traded at a lower cap rate, meaning the cash flow of that real estate is being traded for a lower percentage than interest rates, how do you service your debt? And so you have to keep the cap rates in line with your debt at a minimum. Okay. Now, in a healthy system, what was happening during the pandemic is that cap rates went way down and interest rates went down even lower. So cap rates started going down to meet interest rates, and valuations of property started going up. And so now that interest rates started going up, cap rates were down here. So real estate investments were sitting down, the investors were sitting back stuck in these investments. They couldn't turn them because if they refinanced out, the cash flow didn't produce enough to be able to pay the debt on that real estate. So just like real estate investors, banks work the same way. So if deposits that are coming in are less than the money that they're generating in revenue from their assets coming in, they don't have a way to pay back the debtors. They don't have a way to pay back the depositors that are actually putting money into that bank. So if you come in and say, hey, I have $100,000, I want it out, and multiply that times 1,000 people, 2,000 people, whatever that is, what lands up happening is you land up in a position where you actually can't afford to go in and service that debt. And so strategically, the banks have to be wise on their investments, just like you as an investor. And so the reason that large institutional banks like JP Morgan, like Chase, like Citibank, like Bank of America, and these large banks don't fail is because they're more than banks. These guys are trading. They're trading internationally. There's bonds that they're holding. There's so much involved in a national bank that the government can't penetrate these. The FDIC can't penetrate them because there's multitudes of investments that they're dealing with on assets and exchanges on the NASDAQ, and a lot of what they're doing is worldwide, not just locally. Local, regional, and community banks are the ones getting affected. And it's almost unfair because really national banks shouldn't exist, but the national banks actually run our financial system in this country. And so it's really unconstitutional because they run the Federal Reserve. It's ran by our central banks, and our central banks are the large banks, the large institutional banks. The small community banks are the ones that land up getting hurt in this whole process, and our local regional banks do as well. But what lands up happening is the FDIC goes in and they actually insure up to $250,000. But before they actually do that, they just take over the asset. So the way that you do banking right now doesn't really get affected. So I know a lot of people go back and go, oh my God, what happens to my money? I'm not going to be able to get it out. That's not the case. Here's what happens is the FDIC steps in. They take over the assets. So the way you do banking today is the exact same way you'll do banking tomorrow. The FDIC puts their accountants, their financial professionals, their people in place. And they go into like large hotels and they strategically go in and they take over these banks at night so that depositors don't get concerned with the takeover causing frantics. Okay. And so what lands up happening is they have this entire team. They go in like men in black, just like the movies. And at night they go in and they take over the entire bank. In spite of the CEO, in spite of the owner, they take control of it. So they can open the doors the next morning at 9 a.m. and the depositors can come in. They know that something has happened to the bank because the employees are different. The FDIC is there. There's a chairman that's usually sitting there, and they actually talk to the people of the bank. Now, they don't want you guys to know about this. So when mainstream media gets a hold of this information, it goes national, right? Like it has, or international, like it has. And so they're doing this all the time, ladies and gentlemen. This isn't something new. So the FDIC comes in, they take control of the bank. The bank doesn't land up losing anything. The depositors don't land up losing anything. The bank itself, the owner, the CEO, and the employees are the ones that land up getting hurt in this process. But it's a process that the FDIC feels is to be rewarded. And in so many ways, as you as a depositor, they should, because they're taking care of you guys, right? This happened back in the Great Depression. So in the Great Depression, what landed up happening in the 1930s, when banks started failing, the FDIC was created and backed by our federal government to protect the depositors during the Great Depression. And so since the Great Depression, the FDIC has never let one depositor of insurable cash not get paid. So up to $250,000. So I always tell people, if you're going to deposit into banks, you're going to keep a lot of money in banks, do it in multiple bank accounts so that each bank account doesn't supersede $250,000. Now, a lot of times when we're doing banking, we're doing facilitative investments, we have millions of dollars in the bank at any given time. That money is not protected by the FDIC, although most depositors are protected because the federal government backs the FDIC. So they're part of a governmentally backed agency that protects you guys, the depositors. Now, what the FDIC does is they take this bank and they put it up for private auction. Most people don't know about it, the auction that's going on, and they'll put a press release out to these regional or national banks, and then the regional national banks will come in, and what they'll end up doing is they'll go in and they'll bid on these banks. And so when they go in and they bid on these banks, typically it happens so fast that you don't even realize that this is happening. And then a larger bank comes in, consumes that bank, a healthy bank. A healthy bank comes in and consumes a non-healthy bank. And the FDIC does some audits and some checks and balances to make sure that it is indeed a healthy bank. And so they'll come in and they'll take control of that bank. They'll end up throwing up vinyl signs, branding their bank almost immediately. Depositors come in. They don't have any change in services, banking, or anything. Now, slowly and strategically, that bank will probably adapt their processes and systems to that bank. But initially, they don't. Initially, they just come in and they just take over and assume. And then up to 80% of the depositor's money, if those loans fail later, like banking, like home loans, if student loans, if any type of startup business loans, 80% of the debtor's loans fail over the course of a given amount of time. 80% of that is backed by the federal government. So these banks actually sit in a really good place that are assuming these old banks, because they have an 80% chance of success because that money is insured and backed in spite of what's happened to the bank that they just took over. And so now your money's actually at a better place than it was before in this failing banking system that wasn't working anyhow. So so what's going to happen with SVL Bank is their CEOs, they're done. These regional banks, they're done. And so now what happens is we come in, the FDIC comes in, they strategically auction this bank off. Someone else comes in, the bank opens its doors just like it ever did. It always has. It gets rebranded, new, the same exact product, services, and everything that's happening still gets taken in place. And then over time, they strategically restructure this, and all of you guys are still protected. And 80% of that debt is protected to back the new institution's ability to take over this bank and readapt checks and balances systems that actually help them succeed in the future. So, ladies and gentlemen, there is going to be a little bit of multitudes of things that happen in the future, but I actually think this is a good thing. In spite of what people are telling you, I think that our banking system is going to become stronger. I don't want it to become a monopoly. I hope that they do break down and limit large institutional banking. I think there's a massive need for community banks, credit unions, and regional banks, because those are the guys that are lending to people like you and I that are going out there and starting out businesses. We employ 80% of the U.S. population, entrepreneurs, small business owners, ladies and gentlemen. And so it's important for us to support them, but just understand not to go frantic and stop putting your money into the bank. Temporarily, like I always tell you guys, invest in assets. Don't keep a large amount of money in the bank, but over the course of time, it's going to be okay. This is going to be a house cleaning. The mainstream media got a hold of it. This isn't anything new that doesn't happen. This happens all the time. The FDIC is taking over banks always. This is a process that they're set up for. So this isn't anything that is like new. It's just new to you guys because they're comparing this to what happened in 2008. And yes, there's some of the largest regional banks that are failing right now, but big banks and other healthy banks are going to take them over, and your money is going to be more protected, more backed, and more insured than it ever has before. So ladies and gentlemen, if you like this content, you want more content, more updates, and more information, knowledge, and wisdom just like this, pound that thumbs up button, click and subscribe to our YouTube channel. Go out there and make it a great day and keep crushing it as an investor. Thank you and God bless.